Welcome back. In this video, we're looking at Elevance Health, ticker symbol ELV. This is a stock that I've done videos on in the past, but I believe the stock is at a buy point again, and I haven't released a video on it since February, so I wanted to give you an update. As always, this isn't financial advice, so please do your own research, but I hope you enjoy the video. Elevance Health is the second largest health insurance company in the United States. You may recognize some of their brands like Anthem and Carelon. They, like many other companies in their industry, sold off last year and have been under pressure for various reasons, but among them, many of their health insurance plans were not priced expensively enough to account for increases in medical costs. I believe the market is beginning to price in financial improvement, and while the businesses have a ways to go to fully recover, the market will price in that recovery ahead of time, and Elevance's last earnings report was perhaps not as bad as expected. So we'll take a look at the business, and afterwards I'll give you a up-to-date valuation model for the stock that estimates potential returns over the next 4.5 years or so. We'll also take a look at the stock chart, and I'll show you why I think the stock is currently a buy on a technical basis as well. A big part of my thesis for Elevance has been that they have a moat, and that in the medium to long term, they'll be able to reprice their plans and improve profitability, meaning that if I'm willing to hold the stock for 2 to 5 years, the returns will be quite good. If you're going to understand Elevance's business, one of the key things to understand is something called the benefit expense ratio or medical loss ratio. These two terms essentially represent the same concept. Basically, the benefit expense ratio measures the percentage of premiums that a health insurance company has to pay out for medically related expenses. So when you go to the doctor and your health insurance company has to pay out part of the cost of your visit, that amount that they pay out would negatively affect the company's benefit expense ratio. If Elevance's benefit expense ratio is 90%, for example, that means for every dollar in premiums that they collected, they paid out 90 cents in medically related expenses. So as we go through this earnings presentation and take a look at my notes, keep in mind that idea of the benefit expense ratio. Other themes you'll see include margin pressure and Elevance reducing their number of net customers. Part of this reduction in net customers has been deliberate, as Elevance has been focusing on profitable plans as they look to improve their margins. We'll also take a look at Elevance's plan to drive a minimum of 12% earnings per share growth over the long term. Their plan to do this is not entirely different from what a lot of big companies do, but I think their plan makes sense, and so we'll take a look at that as well. One more note before we get into my notes on the most recent earnings presentation. There was a very recent insider buy for this company as the president and CEO, Gail Boudreaux, purchased over $1 million worth of the company's stock. So we have management alignment here. Okay, so here is a copy of the most recent earnings presentation, and I've marked it up with some notes. We have the benefit expense ratio of 89.7% being better than was expected. Yeah, they also had raised their 2026 adjusted diluted EPS guidance to at least $27. This was supported by a non-recurring benefit that they say they're going to use to fund targeted one-time investments in medical cost management, member experience, provider connectivity, operational efficiency, and Carelon. So you can see some of this is very much aligned, I think, with margin improvement, medical cost management, connectivity, operating efficiency. So operating efficiency, provider connectivity, medical cost management, those all seem to me like things that could help them to improve margins. So they are investing in the business and not just saying, oh, we'll just reprice our plans higher. They're also looking to improve the efficiency and invest in the business in a way that will do that. They also raised their operating cash flow guidance to at least $6 billion, and they said they expect to return at least 12% adjusted diluted earnings per share growth in 2027. So essentially, they raised their guidance in this report, and their benefit expense ratio was better than expected. So if we're looking for recovery in the business, it seems like it's headed at least in that direction. Here I noted their focus on operating performance And I think they pointed this out probably because of their recent margin pressures. And they're saying, hey, we're not just looking to raise our revenue, but we're also looking to improve profitability. On this slide, we had the non-recurring dollar visually represented here, updated 2026 earnings baseline of greater than $26. And so you can see this non-recurring dollar here as a part of this, and then a couple offsetting items. Here on this slide, you can compare quarter two 2026 to quarter two 2025, and we see those things that I've mentioned already, the benefit expense ratio being higher, but being better than expected, which is good. And then adjusted operating margin was lower. So it's again, is that margin pressure. Down here under operating revenue growth was driven by higher premium yields and Carelon RX product revenue, partially offset by anticipated membership declines. So again, declines in the total number of members, but part of that is deliberate because they are trying to have more profitable plans. And then I noted here the higher premium yields. This is part of the thesis that they'll continue to reprice their plans over time to account for those higher medical costs and improve their overall profitability and then ultimately as a part of that, their revenue as well. Here, when we look at this slide about Anthem and WellPoint, we can see the higher premium yields represented by the higher operating revenue, but we can also see the operating margin pressure here down 170 basis points. We can also see how membership was down 1.5%. Again, focusing on profitable plans. They did note the loss of a fee-based customer that they had, and they noted the fewer ACA members. Here on the slide about Carelon, we can see operating revenue improved 6.3%, but again, we see margin pressure down 30 basis points. The total number of adjusted scripts and consumers served were down. I noted operating revenue grew, but operating margin shrank, and they had fewer customers. And at least some of this, if not a lot of it, is because of membership declines, as they noted here. Carelon RX operating revenue benefited from higher revenue per adjusted script, partly offset by lower script volumes due to health plan membership attrition. So the attrition in the number of actual plans that they had was a part of that decline there. So I said we would look at their long-term plan for at least 12% average annual adjusted diluted earnings per share growth. And you can see here the three different factors they're pointing out. Okay, we're looking for high single-digit CAGR revenue growth. And then they're looking for some margin improvement, trying to get operating margin to 5 to 6%. And then they're also looking to deploy capital, not just into the business and reinvest in the business, but into share repurchases. And repurchasing shares is obviously going to help with growing earnings per share, because if you have fewer shares outstanding, that is more earnings per share. So high single-digit CAGR, improving margin, and then returning capital to shareholders with share repurchases. This is pretty similar to what a lot of, mature companies do to try to grow their earnings per share, because a lot of them are not going to grow revenues at 20% a year. And so they're going to look to grow their earnings through a combination of revenue growth, margin improvement, and share repurchases. And that's what we basically see here. But I think that this plan can work and that they do have the operating leverage in the long term to make this happen. Okay, so let's take a look at an updated valuation. Since the last time I valued ELV in a video, the revenue assumptions seem to have been revised down from analysts a bit. And so I've accounted for that in this model. I also lowered my revenue growth rate expectations to 7% for fiscal year 2028, 2029, and 2030. I kept the same net income margin for fiscal year 2030, assuming that they're going to be able to achieve a mean average of what it was between 2015 and 2025. in those fiscal years. I did increase the share reduction rate for this fiscal year and I think next fiscal year as well before going with the 2% the following 3 years because they're actually buying back stock at a rate that was faster than what I had accounted for in the last valuation. So this will have a positive effect on earnings per share growth, while the revenue growth rates being revised downward will have a negative effect on earnings per share growth. So they're kind of working against each other. You have some positive improvement in terms of capital per share being returned, but you have some negative uh, deceleration accounted for, or more negativity in the revenue growth rates, I should say, being accounted for. I believe I left the dividends per share alone, but I did account for the fiscal year 2026 dividends that have already been committed to account for saying, okay, so if, I or you bought the stock today, again, not financial advice, but trying to make it a more accurate model. And then the CAGR number over here is based on 4.5 years because we're about halfway through fiscal year 2026. So I didn't want to base this on, I was trying to keep it based on, fiscal year 2030. And so saying 4.5 years out, what would your compound annual growth rate be based on the assumptions here? So if we have a PE, let's say it trades at a 15 even 5 years out or 4.5 years out, and this earnings per share number becomes true, you account for your dividends, you have your total proceeds here, you have a total upside of almost 94%, and that would be a compound annual growth rate of almost 16%. So you can see, without a crazy multiple on the stock, if they can grow revenue at these rates, improve their margins back to a mean average of what it was, from fiscal years 2015 to 2025, and then their share reduction rate is at this rate, you're looking at a solid return here. So I think that there's a real potential for a really solid return in the stock. And so I posted this yesterday. I said, if I didn't already have enough ELV, I think this would probably be a good place to add, testing the January highs in the 21-week EMA. If it lost a 20-week SMA and you wanted to stop, that could be it. I'm in this one as more of a multi-year investment. So if we take a look at the chart here, you can see we're right up against that 21-week EMA. And if we look at some other moving averages, this is also about, it's above the 100-week SMA, rejected essentially off of the 200-week here. But if we can continue from here and try again and get above that, that would obviously be a positive move. Also above the weekly pivot here. The weekly pivot is at about, if I can scroll out here, 354.14 is where the weekly pivot is. So above that level as well. And if we just look at the structure of the chart, this could be a double bottom. And we've got like a W here that hopefully, this starts to trend back up in the coming weeks. But I think that the overall chart structure looks good. I think that we're at some supports in terms of the moving averages. The RSI on the weekly chart has really reset, and your daily, has reset. We've got a gap here, potential double bottom on the daily here, almost triple bottom, you could say. So this level here is holding. This prior high is holding so far. So I think that there's a lot of things to like here on a technical basis, and where this could be a level that it would make sense to buy the stock. I'm not probably going to buy more because I already have really what I would consider to be a normal full type of position in the stock. I could add more to it, but I'm not in a hurry to. But if I didn't already have as much as I do right now, I would be considering adding to it. That's not financial advice for anyone else. Always do your own research, do your own due diligence, but presenting an idea for you to go and do your own work off of if you want to. There is a gap fill up to 484. So we'll see if the stock could trend positively toward that level in the weeks to come. Another thing that I'll note, and I noted this in one of the Dexcom videos I released recently, is that the healthcare sector of the S&P 500 has sort of lagged this year, and I wouldn't be surprised, especially in a midterm election year, if the healthcare sector were to outperform or perform better in the second half of the year. So that's another reason why I think that this stock could do well relative to the overall market, aside from just what I'm seeing in the chart. And if we take a look at the XLV ETF, you can see that XLV has kind of broken out here to the upside, and we're seeing some consolidation. So maybe it does retest these levels, but I think that overall this looks bullish. And if this sector trends higher, ELV is a part of that sector. Dexcom, which is another stock that I've been buying since the beginning of June. ELV I bought before that, but I bought Dexcom starting in the beginning of June. That's also in this sector. Again, go watch those videos I've done on Dexcom if you haven't yet. But this is another reason why I think that ELV could perform well in the back half of the year and going forward, other than the valuation over the next several years. So if you found this video helpful or informative at all, please click the like button, subscribe, click the bell to get notifications. Follow me on X at Stock Sale Flyer. And as always, drop a comment below. Let me know what you think. I appreciate all your support. Thanks again. Take care. Bye.